Welcome to the Old School Business. Welcome to this pre-gala event and keynote speech, and also welcome to the gala dinner. There will be no speeches, no interruption during the gala dinner, so also a warm welcome to the gala dinner. As I've already said to at least one to at the reception Wednesday, after the gala dinner at 10:30 the club will be open, so if some of you want to continue having a chat or have a drink more, the club is open. Before going to the official program, I'll stay away from John Dukas. I'll stay away from John Dukas because I'll do something that is not in the program. And I know if I'm close to John Dukas, he'll prevent me from doing that. So, John Dukas has founded the European Financial Management Association. He's founded the European Financial Management Journal. John is used to giving out tokens of appreciation, giving out rewards. But now, with this abbreviation of the program, this interruption of the program, we'd like, on behalf of Old School Business, to change roles. Give John a small token of appreciation for his great work for European financial management people.
Thank you very much, Tom.
So, and Peter will. It's a great pleasure to introduce to you Jakob Arnoldi, who is the Chief Manager of Research here at Old School of Business. Jakob Arnoldi will give you the official welcome to the Old School of Business and introduce our keynote speaker.
Well, thank you, Tom. Is this working? It's not. Is it working now? It seems to be. Thank you very much. Thanks, Tom. It's my great pleasure to welcome you here on behalf of Old School of Business. We are pleased to hold this annual conference of the European Financial Management Association. I hope you have enjoyed the school, the city, and of course the conference program in these last days. ASB is a large business school with a broad and diverse portfolio of degree programs and research activities. Besides the conventional programs like finance, marketing, etc., we have degrees programs in subjects such as business law and business communication. We are committed to multidisciplinarity, but we strive to make sure that the basic fundamentals of the individual disciplines are not lost in the process. And of course, and particularly we keep high standards when it comes to methodology. We are quite a big business school. We have more than 8,000 students enrolled in our pre-experience bachelor and master's programs, and more than 1,500 students enrolled in various post-experience programs. We have approximately 320 full-time faculty members and a large staff of part-time teachers. And then the timing is slightly unfortunate, because had this conference been last week, I would have been able to stand here and say to you that during your stay here at Aarhus, we have doubled the size of the business school. The reason is that last week it was decided to merge ASB with the Faculty of Social Science at Aarhus University. The new institution, which will be called Aarhus School of Business and Social Sciences, will be one of the largest institutions offering business and management training in the world. We are actually in fact doubling our size, both in terms of faculty and students. As a business school in a small country in a global world, Aarhus School of Business has to be an international business school. Important for our international program is that we have courses taught exclusively in English, that we have the ability to attract international top faculty, both as visiting and tenured faculty. At the moment, about 1/4 of the faculty members of ASB are international faculty members from different places in the world. And if anybody here should be interested in a stint as visiting scholar, I urge you to get in touch. It's also important, what also is important is our ability to attract good international students. At the moment, we have about 400 outgoing and 400 incoming exchange students each year, and we admit about 1,200 foreign students into our full-time programs. We strive to attract international partners. We have about 140 international partners at the moment. And it is of course important for us to engage and to and attract international research funding, which obviously then is a gateway to research collaboration, to international research collaboration. In order to achieve these goals, we pursue a number of strategies. We have just earned an EQUIS re-accreditation for another 5-year period, and we are also now working on earning the AMBA or the AMBA accreditation as well as the AACSB accreditation. Our international profile, of course, makes it even more interesting and important to host important conferences like the annual conference of the European Financial Management Association. The conference comes at a challenging time. The financial crisis has showed that we need, in some cases, I think, perhaps to we need in some cases to recollect some of the fundamentals that might have been forgotten. And in some other cases we may perhaps need to discard some of the taken for granted knowledge that we normally operate based on. We need, in short, to innovate, and the European Financial Management Association is an organization that contributes significantly to these issues and helps to further these issues. And I hope, of course, that also this conference has taken important steps towards new innovation. Finally, it is my pleasure to introduce a keynote speaker at the conference 2010, Professor William Schwert. Professor Schwert is Professor of Finance and Statistics at the William E. Simon Graduate School of Business, University of Rochester. Mr. Schwert's research covers areas of economics, finance and statistics, like the relations among interest rate, inflation rate and asset returns, the effect of stock market volatility on asset returns, the effects of government regulation on businesses, the market for corporate control, the behavior of the IPO market, and the use of modern time series techniques to analyze economic and financial data. His papers are even extensively cited. Professor Schwert is the managing editor of the Journal of Financial Economics, associate editor of the Journal of Finance, and advisory editor of the Journal of Monetary Economics. Please welcome Professor Schwert.
Well, thank you very much. It sounds like the microphone's working. I have to say, when I was invited to give a talk, the question about what to talk about at that time wasn't so obvious to me, but I came to the conclusion that talking about stock volatility would probably be topical. Probably, unfortunately, too topical. I've been asked by my school to entertain the incoming MBA students for the last couple of years with some discussion of my past research as a way of motivating the students to be excited about the idea that they had research-oriented faculty to teach them. And usually they come away more inspired by the speech than the subsequent classes that are taught, but whatever. A couple of years ago, I volunteered to do this under a little duress. And thought, well, okay, I'll talk about stock volatility, because one of the things I've worked on has been sort of the long time series history of stock volatility in the US and how it relates to real economic activity and doesn't sometimes relate to real economic activity. So I gave this talk in early September of 2008. And at the time, I mean, I don't know if you remember the chronology of our most recent financial crisis, but early September of 2008 really wasn't too bad. And so the theme of the talk at that time was something along the lines, what stock market volatility? And then they had me give the talk to a group of alumni in mid-October of 2008. And at that point, I had to revise the talk somewhat and say, well, okay, fine, stock volatility, but maybe it's not as bad as it seems, because mid-October 2008, it was pretty bad. And the goal in that talk was to say, well, okay, the sky is falling, but maybe it's not completely going to fall down. Maybe things aren't as bad as they seem. To put this in context, and I don't know how bad the news media are in the countries you're from, but where I'm from, they're terrible. And so they tend to get incredibly excited about anything that will cause people to stop doing what they're doing and listen to the newscasters talk. And so when the stock market moves in 100 points, fill in your favorite N, they'll talk about how this was the biggest drop in the stock market in recorded history, and our then presidential candidate, now president, would say things like, well, this is the worst economy since the Great Depression, and we still hear that periodically. And a lot of, I think, what was motivating this reaction was that if you thought about stock volatility, it was sort of exciting at that level. It wasn't really as bad in the real economy as it was, it's nowhere near as bad in the real economy as it was during the Great Depression. And so using this Great Depression analogy, I think created a lot of anxiety and uncertainty. It may have actually contributed to stock volatility for all I know. But the idea that people can look at CNBC or CNN or any of these broadcast media that give you real-time financial prices and see the graphs that going up and down creates much more attention to this than probably was true back in the days when we didn't have 24/7 real-time metering of what was going on in financial markets. But the fact is, what we've lived through in the last couple of years doesn't look all that different from what we've seen in many past experiences, and in fact, it's not even as bad as some of the ones we've seen in the past. The sort of goal tonight is to drag you through a little bit of history. What happened to us? How does it compare to things that happened in the past? Then talk a little bit about forecasting. That is, what does the market tell us now about what volatility is going to be like in the future? And then maybe speculate a little bit about whether there's a problem here and what we should be doing about it. So that's kind of the roadmap of where I'd like to go. All right. What do we mean by stock volatility? Well, I'm going to use I think probably the most common metric for talking about stock volatility. I'm going to talk about the standard deviation of rates of return, percent changes in prices. I think to a finance audience, that's probably very natural to you. To the general public, that's not at all natural to them. I mean, first, the notion of a standard deviation is a scary thought. But even the difference between absolute changes and percent changes can be challenging for many people, and that particularly applies to the news media, for example. At least in the US, they almost always talk about absolute changes. So we're going to talk about these three things, and I'm going to use the Financial Times All-Share Index as the basis for this example. I also have done this with the daily data for the Dow Jones Index that goes back to 1885, and the daily data for the Standard & Poor's Index that goes back to 1928. So some of the things I'm going to say here are even more extreme if you have a longer history to look at. Here I have daily data back to 1968. And if you look at the largest absolute changes in the Financial Times Index, almost all of them have happened in the last 11 years out of this 42-year period. The exceptions are 2 days in 1987, and that's just because the October 19th, 1987 stock market crash in the US happened in 1 day. In the UK, it spread across 2 days. Whatever. So we got 2 of those and 1 in 1998. And if you just look at a table of these, the ones in yellow are the ones that don't occur in the last 11 years. All the rest of them, happened in the last 11 years. And a lot of them, you'll see, are indicated as 2008. So most of the big absolute changes have happened relatively recently. If you prefer graphs to tables of numbers, this is the graph. I got an email in the hotel, was it yesterday or the day before? There was an earthquake in Rochester, New York. Now, I've lived there now for about 35 years, And I don't travel that much. So the fact that being out of Rochester for a few days, caused an earthquake. I suggested maybe I ought to offer to the dean the option of paying me more to stay home, prevent. It wasn't a big earthquake. But the point being, if you look at this graph, it looks a little bit like what a seismologist might see if, in these quiet years, Bill lives in Rochester, nothing happens. Oh, he goes out of the country, wow. Suddenly huge things happen, both up and down, by the way. These are just absolute changes. This would give you the impression that the world was really calm from about 1968 to 1987. We had a little pen plotter skip. Got a little bit less calm in here, and boy, it's gone nuts since, right? I mean, that's the picture you get. Well, that's nobody should look at absolute changes in stock indices. If they're not going to rescale them like they do the consumer price index periodically, looking at absolute changes is more or less a meaningless activity. So if you look at percent changes or rates of return, in contrast, 22 of the 60 largest days are in the 2008 to 2010 period. And oh, by the way, 9 of those were positive. So it wasn't like there were 22 negative drops. I mean, roughly half were positive and half were negative. Those are the ones that have happened in the last couple of years, and all the rest happened at other times. So yes, the last couple of years have been exciting, but they're not the only exciting times. And when we look at a graph, if you don't like tables again, the graph of percentage changes, looks much more homogeneous. This looks like, it's the same process at the beginning as it was at the end. And periodically we get these little episodes of excitement. How many people in here remember 1973 to 1975? I mean, I realize this is mostly a young audience, but I'm asking an honest question. Remember, not your parents told you about it, but you remember it. Okay. Anybody who says they remember, what was 1973 to 1975? OPEC 1, right? It was a big event, all right? I mean, the reason it was called OPEC 1 is because there wasn't an OPEC, OPEC 0 didn't exist. It caused a lot of dislocation in Western economies as they came to deal with the fact that, the supply of oil from the Middle East wasn't going to be as predictable and cheap in the future as it had been in the past. And there was going to be some uncertainty associated with it. So it caused big dislocations. And in fact, in a graph you're going to see in a few minutes, it caused a bigger dislocation in the UK than it did in the US. I mean, it was pretty bad in the US. It was worse in the UK. This is 1987. This is what we've seen recently. Okay? And yes, it's exciting, but it doesn't stand out as being nearly as dramatic in this graph as it does if you, look at the absolute changes, right? And we agree the percentage changes were a more sensible way to think about it. I mean, this is rates of return, effectively. Okay. I'll show you graphs of standard deviations, rolling standard deviations in a minute, but I can't give up, one of the classes I teach at Rochester is a statistics elective to MBAs who really like sadomasochism. Anybody who signs up for statistics elective must be into that. These are the students who are really eager to learn. And so when you teach statistics to MBA students, one of the things you have to teach them, and then you tell them don't do it, that's the ethics component of the course, is how to lie with statistics, right? And one of the ways you lie with statistics is you select the sample you graph so that it makes the point you want to make. And when you look at newspapers and magazines and whatnot, they will lie with statistics right and left to make the point that the author of the article is trying to push. So for example, if you wanted to push the Chicken Little view that the world is coming to an end, you might show a graph like this, which shows a rolling standard deviation of the Financial Times index starting in 2004 and going up through, I think I said the data in this talk went up through June 11th of this year. Okay, so this is not quite real time, but it's close. Okay, and what would you see here? You'd see you know, standard deviation is rolling along at about a 10% per year rate. A little skip up in, you know, mid-2006, but then it comes back down and, 2008, you know, things are starting to look pretty bad. This is where, you know, I gave the talk to the Rochester alumni and said, well, okay, the sky is falling, but maybe it's not going to completely collapse. But it's come back down, all right? And then we had this most recent hiccup, and we can talk about what that was associated with, but it's, you know, it definitely was a recent hiccup. You would definitely come to the conclusion that the world was really pretty good, and then suddenly it went haywire, right? Okay. Here's a little perspective. This is the same plot going back to the beginning of 1968, or actually I think it's towards the end of 68, where my daily data on the Financial Times Index starts. If you look at this graph, which is, you know, the same data, it's just more of it. And it's the same data that lay behind the graphs I showed you a minute ago, the absolute changes and the percent changes. All right, this is just the rolling standard deviation calculated from that. You know, you'd come to the conclusion that, yeah, volatility was high in late 2008. It came back down. It's come back up again. But, oh, by the way, around 2002, we had this little episode. 1987, we certainly had this episode. Arguably, OPEC 1 was worse and lasted longer. Okay? Now, and again, I'm not advertising that OPEC 1 wasn't a bad thing, but we survived it. Okay? The world kept going forward. Capitalism, as we know it, didn't disappear. I mean, maybe it is disappearing, but hopefully not. The idea behind this graph is to try and get you to think, look, sometimes in trying to put in perspective what's happening to us currently, it's not a bad idea to take a broader look at the past and see, you know, what past events were associated with what kind of volatility, and is what we're currently experiencing or recently experienced really that exceptionally bad? Okay, with that speech in mind, I don't have daily data that go back to 1802, but I do have monthly data that go back to 1802 in both the US and the UK. And so what we've done here is calculate an annual standard deviation from the last 12 monthly returns, rates of return, to each of those two market portfolios, and just plotted that graph. And when you do that, you know, this is the picture you get. This is 2008, okay? Yeah, you notice it's there. But again, in the longer history of things, I mean, this is the Great Depression in the US, that red line, much worse, okay? Yeah, it was bad, okay? There's no doubt about it. Moreover, it lasted from roughly 1929 to almost 1940. I mean, that's a decade of volatility like this, right? You know, a lot worse than anything we've seen recently. What else do you see from this graph? Well, there are a couple things that I see here that I think are interesting. One is that, you know, way back in the early 19th century, both the US and UK markets were relatively calm. What happened in this episode here? Does anybody remember 1812 to 1815? The British invaded Washington and burned the Capitol, right? I mean, if you really want to be concerned about the future of the country, you'd think that might have caused a certain amount of anxiety. Doesn't show up in either one of these two stock markets. To be honest, I didn't go back and look up the history of what happened in the UK in 1825, roughly 1827. Obviously, something did. I'm going to have to go look that up. You know, there's something really big happened here, not in the U.S. When we get to about 1834, you start seeing a change in the composition of the market portfolio, because what had been the market portfolio before that were the things that existed in the economy that you could sell shares in, mainly banks and insurance companies, transportation companies. What was transportation? Well, it was things like canals. Okay, the steam engine, the railroads really didn't come into being until about the mid 1830s, and that was a place where there was a big demand for capital to actually build railroads all over the place, and you see a big change in the composition of the real economy and in the stock market, and of course stock volatility went up because it was a more interesting and volatile industry to be in. What happened in here between about 1860 and 1865? Okay, the Civil War. It's the only war the U.S. has had fought on its territory. And it was fought completely on its territory, and all the people who died were on its territory. There was nobody else involved. It's not surprising that the U.S. stock market was more volatile than the U.K. stock market during this period. What's surprising to me, and there was a lot of real capital lost. Human capital, physical capital. I mean, they blew up railroads, they blew up, they burned down the city of Atlanta. And there was all sorts of pretty bad stuff that happened. What shocks me is that volatility wasn't worse than it was in the U.S. in this period. We move along here. In the process of collecting these old stock data, I got to experience the wonderment of going back and reading some of the old business cycle books, some of the early NBER books by Burns and Mitchell and some of the other people who did that. It turns out that the way NBER dated recessions and depressions in the 19th century was largely driven by stock volatility. If they saw a big drop in stock prices and big movements in volatility, they thought, okay, this was a recession. They don't really have very good measures of things like industrial production, certainly not gross domestic product. The one thing they can glean from looking at old newspapers is what was happening in the stock market. And so a lot of the early business cycle literature really was related to these stock price indices. And when they talked about recessions and crises and so forth, one of the ways they were able to time these things was by looking at the behavior of stock prices. There were periods in the 19th century in the US, and I'm sure in the UK too, where there were massive bank failures. There weren't things like government agencies that insured the checking and savings accounts that individuals put money into. You would put money in your bank, you'd show up at the front door with a check and say, give me my money, and they'd say, well, that's an interesting idea. We don't have any to give you, and so forth. It created a set of regulations that happened in the US in the early 20th century, and then again later in about the 1930s, to try and provide a little more financial stability. I wouldn't advertise that what the US Congress is currently talking about doing is going to have similar beneficial effects, but there probably were some beneficial effects of having some kind of centralized deposit insurance and so forth. The Depression was obviously not a great period. OPEC 1 was not a great period, and oh, by the way, you'll notice it was a lot worse in the UK than the US. That's what I was mentioning before. I mean, the spike in the UK volatility was much higher than the US data. And we've seen things since then, that really make the most recent episode not nearly as exciting looking as you might think in the broader scope of history, okay? We're now talking about, 220 years of data, 210 years of data. And yeah, we did have some problems. We do have some problems. We still have some problems to deal with. But, it doesn't cause me to think the world is coming apart. One of the things we have today that we didn't have back in the 20th, and certainly not the 19th century, are the ability to use things that get traded in financial markets to help us see the future, forecast the future. The Chicago Board Options Exchange, and I don't think they did that because they knew people were going to want to know what was happening in the middle of the financial crisis, but it turned out to be a useful thing, has created something called the VIX, which is simply the implied annualized standard deviation to the Standard & Poor's 500 index that they infer from looking at put and call option prices for the Standard & Poor's 500 index that have 30 days to maturity. So they created this index, the VIX, which they report certainly daily, sometimes continuously, and have for quite a long time now, with the goal of being able to create securities which then trade on the value of the VIX. And they now have those. They have options on the VIX, they have term structures of VIX, and they have futures on the VIX. And we can use the term structures and the futures to infer what the market thinks the future path of volatility will be after seeing various events. If you use time series techniques like the Garch models that Rob Engel has popularized, they would tell you, typically, that a big shock to volatility would be very persistent. In other words, if volatility jumps up a lot, it's going to stay up for a long time. One of the things that we've seen in this most recent episode is that when you look at the contingent claims markets, the options markets and the futures markets, they give you pretty good signals that people don't believe volatility was going to stay up at super high levels for super long periods of time. Let me give you some examples. This is a graph. It's kind of an ugly graph, but this is I'll try and walk through it a little bit slowly. This is a graph that shows the forward structure of implied volatility at various times during 2008 to 2010. What do I mean by a forward structure? Well, it's just exactly like forward interest rates. If you have an implied volatility from an options contract that is 3 years out into the future, and you have an implied volatility for an options contract that's 2 years out in the future, you can figure out what the forward volatility is by taking that 3-year volatility and backing out what the volatility in the 2-year contract is, and then what's left is the volatility that would exist for that incremental year. Okay? What was fairly normal? Well, if you look at the mid-July 2008 graph, that's this blue line. It's A low, around 25% per year, and B flat. That is, 25%, it doesn't matter how far in the future you are looking, 25% is the number we're expecting, okay? If we move forward to November 2008, November 2008 was, excuse me, at least in the US, November 2008 was in a period where when you went home from work on Friday evening, you weren't quite sure which investment banks were still going to be in existence when you got back to work and got back to the office in the morning on Monday, because quite frequently they disappeared over the weekend. And so, it was a pretty exciting period. That's November 2008. The very, very short-term implied volatility was about 65% per year. Now, if you thought, this is just a back-of-the-envelope calculation, but if you thought of stock returns as having a normal distribution with a standard deviation of 65% per year, what does that tell you the chances of ending up at zero are? Well, they're non-zero. That volatility that's that high would get you worried, okay? And so very short term, this is what the market was seeing. But as you looked out even 1 month, 2 months, or 3 months, it dropped down quite substantially. And by the time you were out to a year into the future, it was well below the level that you expected for the very short term. So the market, even in this period when it looked like the whole financial sector was falling apart, anticipated that things would settle down looking at it in the future fairly quickly. The persistence and volatility wouldn't be that long-lived. When we got even to January of 2009, things got a little calmer. April of 2009 is that line. Arguably, this is roughly, 2 months after President Obama had been inaugurated. Stock market wasn't all that enthusiastic about it, but volatility had certainly settled down, and people were not nearly as concerned. When we get to June 2nd of 2010, we're looking at slightly below 30%, up and down, up and down. It was actually higher looking further out. I don't know whether that's something to do with anticipating what's going to happen after the next election cycle in the U.S. or whatever. But the point being, it had returned to a much more normal shape of this volatility term structure graph. If we look at the futures contracts, and the futures contract is exactly what it says it is. It's a bet, just a side bet, on where the VIX will be. And again, the VIX is something that is calculated and reported using a known formula by the CBOE more or less on a continuous basis. The forward graph for the long-term volatility futures contract, and the maturity of that contract varies through time, but the average is about 0.8 of a year, so it's about 5/6 of a year, 10 months or so, roughly. You can see that, and the futures contract's been in existence since early 2004. You can see that the forecast of long-term volatility, or volatility farther into the future, tracks realized volatility fairly closely, but at a much more muted level. Okay, I mean, if you're looking out a year, which is roughly what this forward contract's doing, it doesn't spike nearly as much as the sort of spot rate did, if you want to think of it that way. And our more recent evidence recently has people worried. Watching the TV shows of the riots in Greece and whatnot probably didn't warm people's hearts in terms of feeling stable. But it's still nothing as dramatic as the spot rate would be. Okay. So far, what I've been talking about is market volatility, sort of broad measures of stock market price behavior, the Standard & Poor's Index, the FTSE Index, the Dow Jones Index, whatnot. In a lot of cases, these are not broad market phenomena. For example, in the late 90s and early 2000, it's basically between 1998 and 2002, how many people in here remember that era? Okay, it's getting pretty bad. Good. Well, have you heard of the dot-com bubble? Okay. Roughly speaking, that was the time period we're talking about. People who were in the business of teaching in business schools, especially deaning in business schools, I mean, that was really tough, because students were dropping out of first-rate MBA programs to go start companies, because the only way to get rich was to start a company and name it something.com quick. If you waited to finish that 2-year MBA program before you did it, your opportunity might be lost. I mean, it was that ridiculous. And so, there was some very idiosyncratic behavior of a sector of the stock market. I'm going to call it the technology sector. And the reason I call it the technology sector and not the dot-com sector is it turns out this applies to biotech as well. It wasn't just internet, it wasn't just .com, it wasn't just even computers. It also applied to biotechnology. I mean, the behavior of biotechnology stocks also behaved similarly. And there was, I don't know whether they call it a bubble or whatever. This is a graph, I don't like the word bubble, but this is a graph that shows the implied volatility of the Standard & Poor's Index, the VIX, and the blue line is the VXN, when the jargon for that in the financial community is the vixen. Okay, I don't know why. I mean, these Wall Street guys just can't help themselves. They're almost as bad as marketing people for coming up with, funny little acronyms. But in any case, we have the VIX and the vixen. The Vixen is the implied volatility for the NASDAQ composite portfolio. And if you look at the graph of these things, you see that, when they started calculating the Vixen, it was actually pretty similar to the level of the S&P 500, and pretty much up until about 2005, it's always been higher. And in this period, 98 to 2002, it was a lot higher, okay? This next graph, I think, makes that point even more dramatically. It is simply the ratio of the Vixen to the VIX. So it's how much more volatile the technology portfolio, since the NASDAQ portfolio in this period at least was dominated by technology stocks, was than the S&P portfolio. And what you see is, roughly between 98 and 2002, this went from a normal level of something, 150% of the S&P index up to almost 250%. And what's happened since then, since 2002, is it came back down to about 1.5 times as high, and now, really for the last year and a half, and in particular in our most recent episode, technology stocks really, look like everybody else. All right? They behave pretty much the same. So it was clear that at least in this little episode, technology stocks behaved, as represented by this NASDAQ index, behaved much differently than sort of the broader economic market. And volatility we saw in technology stocks behave differently. There isn't a similar portfolio, especially not one that the CBOE has created an implied volatility for. So to illustrate what happened in 2008, 2009, I put together a couple of different sources of data on financial stocks. One is the data stream U.S. financial portfolio, one was the NASDAQ financial portfolio, and one is the S&P 1200 financial portfolio. They all moved together. They increased modestly during the technology bubble, if you want to call it that way, 98 to 2002. 2008, 2009 was obviously much different, okay? If you look at this graph, it's quite clear that the events we had in the last couple of years were highly focused in the financial sector. It's not that the rest of the economy wasn't affected. I mean, I'm sure if we put General Motors in there, they would not look good either. Without making too much of an editorial comment, most of the TARP money in the U.S. Went to General Motors, not to the financial institutions. Most of the money given to the financial institutions went back into the U.S. government already, except the money that was given to General Motors. And the main beneficiaries of this were not the bondholders of General Motors, but the members of the United Auto Workers Union. But nonetheless, anyway. So General Motors probably didn't do so well either, but the financial sectors are the ones who really got hammered and are still getting hammered. And that does stick out as by far the worst, at least going back to 73, period for this set of stocks. And if you think about sort of who was getting hammered or who was being talked about, it was pretty much all financial services firms and a wide variety of them. Insurance companies, investment banks, commercial banks, brokers, companies from all over the world in this sector. They did not have the same experience in the late 98, 2002 period that the technology stocks did, and OPEC 1 didn't do much to them either. Okay, so what do we know from all this? All this and more, by the way. Well, we know that typically stock volatility really jumps up after a big drop in the level of prices. Okay, when you see a crash, that's when you get a big spike in volatility. It's not that you don't get big positive returns also. I mean, part of having high volatility is you have high positive and negative returns after that. But what seems to trigger increases in volatility is a drop in prices. That's a pretty well-known fact. And that's consistent with what we've seen recently. The other thing that's true is if you don't focus on percent changes, you can think volatility is a lot worse than it really is. Because as long as the index level is really high, you're going to get really big absolute changes in the index number. What do we do about this? Well, first, is this a problem? I mean, is stock volatility in itself a problem? It certainly creates work and probably market demand for the services of news reporters because they have something to talk about. All right? And for them, that's probably not a problem. I mean, things that are, if the world didn't have, floods and murders and scandals and who knows what else, what would news reporters do, right? I mean, they have to have something to talk about. They can talk about the team that lost in the World Cup, but, that only lasts for so long. So they need, something to talk about. So for them, it's not a bad thing. What about for the rest of us? Periodically, how many of you work in schools where you have a public relations office or marketing office and they want you to talk to the press periodically? Yeah, okay. The rest of you will discover them. Once you start writing papers that seem at all controversial, somebody in your school will talk to you and want you to talk to the press. Those people like having, volatility because it gives somebody to talk to, some excuse to talk to the press. Is it a problem in general? I don't even watch intraday movements of stock prices. I mean, we have Bloomberg screens all over the building in the Simon School, and I consciously try not to watch when I walk by. I may notice that the colors are green instead of red. Green means up and red means down. Beyond that, I try not to pay too much attention because it doesn't affect anything I do. I'm not going to do intraday trading. Okay, I mean, I just don't. If you teach your students you should do intraday trading, hopefully there are people who are going to go work for either one of the hedge funds that provides intraday liquidity or a brokerage firm that makes money selling services for people who want to be intraday traders. Most of us are teaching something that is analogous to buy and hold and don't pay your broker too much by trading too much, right? Maybe not all that's what we're teaching, but that's a lot of what we teach. So paying attention to intraday movements in prices really isn't something that most people in the world should do. Even daily movements in prices. Truth is, if you were giving advice to the man on the street, really you shouldn't be paying a lot of attention to it. All right? There's not a lot of evidence that, the way they should treat any decision they're making in their lives should be altered dramatically by listening to the news at night about what's happening in the stock market. Having said that, reality is people do worry. All right? And they certainly don't like it when prices drop, okay? I'm not denying that. But what can we do about it? I mean, should we solve the problem? There's this fascinating little paper published in the JFE by Ken French and Dick Roll that made the observation that the variability of stock returns over weekends, measured by the Standard & Poor's 500 index, is about the same as the variability on any given trading day during the week. Okay? How many people read the New York Times or the Times of London or whatever on Saturday or Sunday? Well, the New York Times is a big fat newspaper, right? And the Sunday New York Times weighs a ton. They haven't figured out yet about the not wanting to cut down trees thing. But there's lots of news that happens on weekends. It's not just during trading days. And yet, the empirical fact seems to be, roughly speaking, that the variability of stock prices from the close of trading on Friday to the close of trading on Monday is about a one-day variance. Okay, just like it would be from the close of trading on Monday to the close of trading on Tuesday. Even though there were 3 days of news. Okay? That has led some people to the conclusion that maybe we should just shut down trading. Trade once a week, and there'd only be a fifth as much variability. Nobody really seriously believes that, although I think Joe Stiglitz once really thought that might be true. I don't think that's the right answer. I mean, we live in a world where trading goes on 24/7, really. I mean, in anything that really matters. The idea of shutting down trading doesn't seem to me to be an obviously good idea as a way to solve the problem of volatility. It's not going to make volatility go away. Regulation of trading, yeah, we're going to get more of that. Taxes on trading, that's one of the current buzzwords in our policy debate. Should we have transactions taxes? What's the obvious outcome of doing people like Larry Summers and Joe Stiglitz have advocated, this is like throwing sand in the gears, of the machine to slow it down a little bit. Yeah, well, it'll slow it down. It'll also create a lot of, repair bills too, right? Is it obvious that's somehow going to make volatility less of a problem? You may not see it, but it doesn't mean it's not going to be there. And the reason why it's occurring, is going to happen anyway. And it's not going to. It's like saying, well, if we don't stick the thermometer in your child's mouth, we won't realize he's running 102 fever. Well, you won't. Doesn't mean he's not sick, right? So I think you need to be cautious in thinking about solving the problem of volatility by using these, kind of brute force mechanisms to make trading harder to do. And I guess the last observation I would make along those same lines is we live in a world where you can do trading from anywhere. And so if the US, the UK, Germany, France, Japan, all get together and agree that we're not going to allow certain kinds of things to be traded, Bermuda, Cayman Islands, go down to this, we'll figure out a way to do the trading and everybody will go there and trade. It's not going to, you can't put the genie back in the bottle. You can't uninvent options. You can't uninvent futures contracts. You can't uninvent swaps. You might tell people who write them that they have to collateralize themselves better so that they actually are a stable counterparty. That's a different question. But just simply saying, well, we shouldn't do these anymore, is not going to happen. Okay. Looking at my watch. Do I have time for a couple of questions or not?
Yeah, sure.
Okay. That's pretty much what I wanted to say. So if I can probably take a couple questions if you have some. And if they're too hard, I'll just say that's too hard.
Okay.
And they may be too hard. Anybody? Yes.
What kind of impact do you think that the introduction of these volatility futures and options will have on the long run and on the level of volatility?
I don't think much at all. I think what you're going to see, the main impact of it, and the reason they created them, is that because volatility is negatively correlated with stock returns, there's going to be a big demand for trading these things for people who want to hedge their stock portfolios. I mean, if you want to be able to take a position that isn't just a put or a call on a market index, for example, taking a futures contract on volatility is a relatively easy way to construct a hedge that gives you diversification against market risk. And so, I mean, in fact, if you look on the CBOE webpage, they advertise this. I mean, they have testimonials about what a great thing this is to put a futures contract in the VIX into your diversified portfolio and how much risk reduction you get from doing that. So, I mean, it's not random that they come up with these. I mean, they don't come up with the ideas for trading derivatives randomly. They do it because they think there's a market for this and they can sell it and create trading, transaction. The thing we call transactions costs, they're profits to them. So I don't think it'll have any effect on the level of volatility itself, but it'll have a big impact on people's ability to do hedging in ways that we weren't able to do before then, or weren't able to do easily. I mean, trading there's no doubt that, I shouldn't say that. This is going to be on the web for a year, right? I suspect, how's that, rather than there's no doubt, I suspect that trading a standardized exchange-traded futures or options contract is cheaper for most people than doing any kind of over-the-counter derivative would be. So, as a mechanism for most people to do risk management, this is probably a good thing.
Why does he say it is cheaper?
Why is it cheaper? Because it's standardized, there's a clearing mechanism, and the profit margins of the investment banks that write the over-counter derivatives are ridiculously high on those products. Whereas when you're dealing with an exchange-traded thing, there's really not much profit margin here. So that's why I think it's cheaper. You can edit that out of the tape. Yes?
Professor Schwert, how do you think that other markets' volatility, for example, forex markets' volatility, affects the stock market? Well, more specifically, I've read that in the recent flash crash, forex market was leading the volatility. And is that a relevant question, first of all?
Yeah, words like cause always make me feel uncomfortable. I'm going to admit, I don't know what created that little hiccup. I know it was a microstructure phenomenon. And what do I mean by that? I know it was trading systems that weren't really well designed to deal with the situation they were in. I mean, when the stock price of Procter & Gamble goes from $70 to 8 cents intraday, I too admit, and then goes back up again. I too admit, that doesn't sound right. I mean, somebody built a computer program not very well. All right, I mean, that's pretty clear. But having said that, I don't know who or why. I mean, I don't think we yet know enough about what really happened to be able to point the finger at, sort of what the error was that created this anomaly. I think the people who are heavily involved in the market have some strong suspicions about it, but at the moment they're just strong suspicions. And I don't have any direct evidence, so I don't really want to go on record saying I think I know what the answer was. I mean, I've heard stories, but it's easy for me to believe that a currency market might seem to move faster than something like a stock market because, the S&P 500, for example, is just a composite of 500 stock prices. They don't all move in unison, right? But a currency exchange rate, I mean, that's pretty much it's a really standardized commodity and everybody sees the screens from everybody else. So if there's something moving, it's like, how quickly you stick the thermometer in your kid's mouth. The thermometer is always in the mouth of that market. It's going to be harder to see in things like stock index behavior. That'll move more sluggishly just because of the non-synchronous trading issue. But I don't think currency volatility caused it. Again, I hate the word cause.
No, I not insist on the cause.
Yeah, I know.
The fact that it's leading
But again, leading just, it's easier to see what's happening, right, quickly. I'm not sure it's necessarily any more than that. Well, yeah.
Over the last 2 decades, we see after each crisis, the regulator asks companies to disclose more information and to be more transparent.
Yeah.
With the presence of noise traders and the increasing participation over time, this providing too much information can make the market more unstable rather than stable.
There's a lot of assumptions built into that question. Who do you think are the noise traders?
We call them irrational, non-institutional investors, retail investors.
Okay, you think the retail investors are the noise traders. There are some people who think the institutional traders are noise traders. You know, if we got them all in the room together and said, okay, everybody raise your hand if you think you're a noise trader, you know, those models are cute, but you know, it's always a little hard for me to know exactly who to identify with. You know, you're the noise trader and you're the informed trader. Most everybody I've ever dealt with who deals in financial markets thinks they're informed, you know, despite what their track record might tell you. So, you know, I always have a hard time knowing exactly how, you know, that works. If you look at the accounting literature, where they try and study, you know, how informative are stock prices before and after some change in accounting regulations. And again, I'm not an accountant, and I don't claim to be an expert in it, but I have had a lot of PhD students who are pretty good accountants and who probably are experts at it, and I end up seeing a lot of these papers come across my transom at the JFE. I don't think there's overwhelming evidence that changes in accounting rules have changed in any fundamental way the behavior of stock prices. I mean, there's some very loose evidence that more disclosure in a more developed economy with better capital markets seems to be associated with higher prices, but it tends to be sort of the economic development cross-sectional stuff as opposed to the time series stuff where you change a rule in the US, for example. So, you know, and I haven't seen anybody who claimed that more disclosure created more volatility just because there was more information for people to be misled by. Although, you know, there probably are papers that say that. I just don't remember them. That's one more question. Is that a fair one? Yeah. Okay.
Is there a bad or good volatility?
Is there a what?
A bad or good volatility? Is volatility good or bad? Can we characterize it?
I think of volatility as being like my kids. They just are. You know, they're not bad, they're not good. You know, sometimes they behave better than others. Sometimes you like them better than others, but you know, they're always your kids. I think, at least that's the way I view my kids. And this will be on the web for a year, so I get to, I'll give them some incentive to go look. You know, volatility is just a characteristic of the markets we see. I mean, when I teach statistics, I mean, you know, it's like, is there a good R squared or a bad R squared? You know, the very first thing I tell my students is there's no such thing as a bad R squared. You know, the R squared, you want the best R squared you can get for a given dependent variable and a given set of independent variables. You know, get the functional form right or whatever. But, you know, if it's 2%, you know, that's not a bad R squared if what you're trying to do is use predetermined variables to predict stock returns, right? If it's 95%, you know, that's not very good if what you're trying to do is explain something that's essentially an engineering equation, you know? I mean, it says you've got a lot of measurement error in something. I have this funny little example where I try and explain to my MBA students the benefits of using logarithms. Where, you know, you've got this guy running the packaging store that has different boxes with different volumes of popcorn that he can put into them. And he has 3 variables he can use to predict volume: height, weight, and length. And, you know, if you run that regression over the set of boxes he has, you get an R squared of 95%. You know, it looks all pretty good. Of course, if you did logs, you get an R squared of 100% because they teach you that the volume of a cube is height times weight times length. Which means obviously that's a much better model, you know. But you know, like there's no good or bad R squared, there's no good or bad volatility. You know, it's a description of what's going on, and it's high when people are uncertain.
Yeah, but why is it then people worry about it? If
Well,
volatility is
because
not bad,
that's a
why-
good. Well, okay. Here's the reason why. It is like your temperature. All right. I mean, you stick the thermometer in the kid's mouth, it's 98.6. I mean, that's Fahrenheit, isn't it? What do you guys, what's normal centigrade? Fine. 37? Fine. It's 37. I got to remember this is the EFMA meeting. It's 37, okay? That's normal. If you stick it in and it's 38, well, that's not good, but you don't blame the thermometer, right? You go get the aspirin or Tylenol. I guess they don't sell Tylenol anymore. Well, whatever, you get whatever it is you make the fever go away with. But do you understand what I'm saying? It's not, you know, it's the reason you have a temperature is because it's a reflection of the fact you're sick. You know, volatility is high because we had some severe economic problems. I mean, there were some financial institutions that should have and did go out of business in various ways, right? And, you know, that created some anxiety. We now have unemployment. Oh, by the way, the link between financial volatility and real economic behavior, things like unemployment and so forth, isn't that strong. You know, I mean, yes, we have some unemployment, but it's not Great Depression-like unemployment. So people see it and worry about it because, you know, during times when we've had recessions, volatility's been high. But that's just because, you know, you run a fever when you're sick. It doesn't mean it's bad. And telling people don't stick the thermometer in your kid's mouth because if you get worried that they're running a fever, that's not a solution to anything.
I agree. I'm not worried about thermometer. I'm worried about
Okay.
what if cocodamol is not available?
What if the
medicine is not available? That's
it doesn't make it any, I mean, well, I guess the question, I mean, in some way, okay. In some ways, you're saying the same thing I said in a different way, which is for your personal psychological welfare, if there's nothing you can do about it, you should probably not look at the Bloomberg screen, okay? I mean, if it makes your blood pressure go up to see the prices doing this, don't look, okay? And when the PR people at the Simon School asked me to say something to the press, you know, when we had the little hiccup, you know, mostly what I was willing to say is don't look, you know? You really shouldn't be paying attention to stuff like that because it isn't going to alter, you know, unless you're trading. I mean, one of my sons works for a hedge fund, and for him it mattered, okay? They were busy trying to buy like crazy, okay? They couldn't get their trades executed because the prices were dropping so fast. And they did get some trades executed, and they were executed at prices that didn't violate the 60% rule or whatever it was NASDAQ arbitrarily came back with to say, you know, if the price dropped more than 60% from the previous day's close, then we just void that trade. So they were not in the voided trade category, but they didn't get to trade nearly as much as they wanted to. They're in the business of being liquidity providers, and the market obviously needed liquidity and was willing to pay a ridiculous amount for it. If you're in that business, pay attention. If you're not in that, I mean, I teach, okay? We all teach. I don't have time to watch the Bloomberg screen continuously, okay? I mean, nowhere near time. So why would you want to do it? I mean, especially if it makes you feel bad, right? So just don't look. You know, if there's nothing we can do about it, right? All it does is make you feel bad. Don't look. That's my best advice. All right, I think that's probably, everybody's overworked from this. Thank you very much.
Thank you very much for an excellent and very timely talk. And on behalf of the EFMA, I would present you with a standard present and a small certificate and another present.
Oh, thank you so much.
Thank you, I appreciate it.
Oh my goodness, okay. I don't know if my luggage is
I will thank you.